Bank failures in March mark the first latent effect from the Fed's aggressive tightening cycle, according to commentary from Clearbridge Investments. The asset management firm now notes that broader risks may materialize later this year, teeing up a recession that's longer and more moderate than expected as tighter lending standards reduce credit availability, weighing on GDP growth. For more on these risks and how you can protect your portfolio, let's get to Jeff Schulze, Clearbridge Investments Chief Investment Officer. Jeff, let's get right into it. What are your first thoughts?
Well, I think the First Republic news this morning is a win-win-win, right? It's obviously accretive to JPMorgan's bottom line. It's the best case scenario for First Republic employees, and it limits the loss for the FDIC. So obviously, I think this clears up the one last bit of uncertainty from the banking crisis in March. But the thing that's going to continue to weigh on economic activity as you look out on the horizon, even if this is a little bit more idiosyncratic than systematic, is tighter lending standards. Now, we're going to get a senior Fed loan survey next week, which will tell us to the degree of which tighter lending standards have happened. But ultimately, I think this weighs on the credit availability in the economy. And it's important to note that lending standards were already at recessionary levels prior to those banking issues. So this is just going to complicate the issue a little bit further.
Is it at all a concern that it once again was JPMorgan that was making the acquisition here, and it wasn't a smaller or a regional bank that was taking on the assets here from First Republic, a bank like PNC, for instance?
Yeah, I think this was the natural suitor for this situation. Very strong balance sheet, well capitalized, able to take this and not really blink an eye. But again, I think a lot of the tightening in lending standards isn't going to be at your larger banks. It's going to be at your smaller banks, obviously banks outside of the top 25 in assets. But more importantly, these banks have very strong relationships with small businesses. And small businesses are starting to feel the impact on profitability from higher interest expenses, and they're not having the ability to pass through higher price increases, and their compensation structures are relatively sticky. So profitability is being hit from a number of different ways with small businesses, and I think it's only a matter of time before you see the layoff cycle broaden from larger companies to Main Street America. And I think the rubber hits the road in the third quarter when that ultimately materializes.
So, Jeff, you see the tightening happening with regard, or the potential for more tightening happening with regard to smaller banks. What's the ripple effect from there? What's the consequence of that?
Well, again, if you look at this particular cycle, a lot of the strength that you have seen were from small businesses. A way to kind of glean out this information is to look at job openings. Prior to the pandemic, there were 7 million job openings. Today, we sit at about 10 million. So there's 3 million excess job openings. When you look at who those excess job openings belong to, about 94% of them are small businesses or businesses with less than 250 employees. And these same businesses make up about 45% of the employment picture in the U.S. So a lot of the resilience that you've seen from the labor market, the inflation, the hotter wage growth, are coming from small businesses. And again, if you're going to see tighter lending standards and an assault on profitability for small businesses, that's going to cause a recession. And again, I think that materializes in the second half of the year.
Where are we to first see then those wage adjustments, though? And I guess if we do get to that point where, yeah, small businesses, they're seeing a hit on profitability, cannot sustain the same type of wages that large enterprises might. So where might that start to show up?
Well, it hasn't shown up quite yet. If you look at the employment cost index data that we got on Friday, it shows that wages have peaked, but they're plateauing at a very elevated level. Rhymes with what you're seeing from the Atlanta Fed's wage tracker. So this is an issue. This obviously keeps the Fed in a more hawkish, higher for longer mode. But ultimately, I think the Fed being higher for longer with this wage dynamic is what ultimately causes a deeper recession than what consensus is anticipating. So while most people think it'll be a 1 or 2 on a scale of 10 type of recession, we're thinking because of this delayed reaction function from the Fed and the stickiness that you're seeing with wage growth, we think it's probably going to be a 4 or 5 when all is said and done.
Jeff, you mentioned the jobs numbers that you've seen, that we've all seen, and the data points have been strong there. We have a big jobs report coming at the end of this week. If the job market continues to show strength, are the odds of a recession pushed further out? Is the potential for a recession pushed past 2023?
Well, yeah, the more resilience that you have in the labor market, obviously that's going to push the recession from the third quarter, which is our anticipation, maybe into the fourth quarter of 2024. But I think also more importantly, if you have a stronger labor market, you have stickier wage growth, stickier inflation, that invites the Fed to continue to hike past what they view as terminal, which is one more rate hike from here. So yes, if you see that dynamic, it certainly could push it out a little bit further. But one of the reasons why I think it won't be a 2024 type of recession is because if you look at the leading economic indicator index by the Conference Board, you've seen 12 consecutive monthly declines. The only two times that you've seen more consecutive monthly declines was 1973 and 2007. Maybe looking at that from a different vantage point, the LEIs are down 7.8% on a year-over-year basis. The largest drop that you've ever seen with the LEIs ahead of a recession was 5.7% back in 1980. So no matter how you cut this, even if you do have a more resilient labor market, I think a recession is on the horizon, and I don't necessarily see it bleeding to 2024.
May the Conference Board be your guide. I think we just came up with a new tagline for them. We'll get some commission on that somehow, Jeff. Jeff Schulze, who is the Clearbridge Investment CIO. Jeff, thanks for taking the time this morning.
Thank you.